It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're looking at the investment potential in Japan amid the country's improving corporate governance. I'm here with Hennessy Japan Fund Portfolio Manager Masa Takeda. Thank you so much for being here. Appreciate it.
Thanks for having me.
So let's get straight to the stock that you like here. It's called ORIX. It is the largest diversified financier by market cap in Japan. We've seen the stock do pretty well this year. We've seen it rise about 26.5%. So let's talk about why you still like it here. And first of all, has to do with tourism to Japan. We actually have a chart of what we've been seeing here. We had a sort of peak in the late teens, and then it's coming back up towards that level right now. Why is that good news for them?
Right. So you might think, because it's a financial services company, why is it a beneficiary? Well, so they have three segments that that have been benefiting in a big way. One, they are the owner of Kansai International Airport. So they're an investment company, so they own these crown jewel assets. That's a monopoly business. Number two, they're in aircraft leasing business. Avalon and ORIX Aviation combined, they are the third largest in the world. And it's a wonderful time to be aircraft leasing business. And then thirdly, they run hotels and they own hotel properties across Japan. Again, inbound tourism, the business is thriving. So, I call them hidden beneficiary of Japan's inbound tourism.
Right, because as you say, you wouldn't necessarily think a company in finance would be connected, but because of that assets, those assets. Also, of course, Japan, the Bank of Japan has been normalizing rates. Talk to me about what that does for ORIX's investments.
Sure. So this is a financial services company by origin. So they started as a leasing business, and then they branched into lending business, life insurance, private equity, private lending, and so on and so forth. And these are obviously beneficiary of rising interest rates. We talk about rate hikes in Japan, but that sounds a little bit too hawkish. In fact, it's all about normalization of interest rates in Japan. And this is a nice tailwind for these types of businesses that have suffered for so many years.
Interesting. And then finally, even though the stock has been up, as we looked at, the valuation to you still looks attractive. What valuation metric are you using?
Well, so I think the easiest metric you can look at is the price to book, and even based on reported BPS, price to book is touched below 1 times book. Now, the company, being an investment company, they have a lot of unrealized gains on assets on the balance sheet. Some of them show up in the balance sheet, some of them don't. Some of them don't show up. So on the market value based book value per share, their price to book is far less than 1 times right now. P multiple also 10 times or less than 10 times. Dividend yield 4 times. I think it's a very, very attractive valuation.
Interesting. So we always like to point out what could potentially go wrong or what's a risk. And that would be if there's a global recession, because it would sort of pull down some of these investments along with it. What do you think the likelihood, though, of that is at this point?
Well, obviously, there's always unknowns, but, anything financial is always sensitive and vulnerable to exogenous events. And so, of course, ORIX is not going to escape that, although we would see it as a potential buying opportunity. The other thing is, if the rates will continue to remain high in the US, they have some US operations, one of which is mortgage origination. And so, housing demand could be dampened if the rates continue to creep up.
Gotcha. So we'll keep an eye on that. And then the stock that you're saying folks maybe should avoid here is Hitachi, a name that is a little more familiar to U.S. consumers. It's a conglomerate that owns electronics, makes electronics, for example. Now, this stock has just about doubled over the past 12 months. And so one of the reasons that you don't like it as much is because all of that capital has flowed into it?
Correct. So we're shareholders. We invested back in 2021, saying that it was trading at 10 times PE with return on equity to 15%. And it was back then regarded as cheap manufacturing conglomerate. But our argument for this name was, this is a company that is starting to focus on transitioning from traditional hardware sales model to solution provider model. And this company has IT expertise, and they have operational technology. So they run mission-critical social infrastructure, and they also have manufacturing expertise. There are not a lot of companies out there with all these three types of expertise under the same roof. Now, 2 years, 3 years fast forward, now it's become everyone's favorite, so it's less attractive for sure.
Yeah, less of that sort of hidden jewel, I guess. They have a large backlog, as you pointed out to us. How does that then translate into revenue and profits?
So seeing a huge backlog, is encouraging. But then, of course, engineering, if you're an engineering company, EPC company, history is rife with cost overrun, So it'll be interesting to see whether they can successfully translate that backlog into solid revenue growth and profit growth.
And then finally, you talked about that transition that they've been trying to make. How has that been going, and how quickly has it been happening?
So again, our argument was initially it was going from manufacturing conglomerate to solution-based provider. And now the pace of that transition, of course, it remains to be seen. So far, so good. And I think if they continue to focus, if they continue to go in this direction, naturally the returns on capital should improve and cash flow generation should improve as well. And that should be good for valuation matrix. So, we expected multiple re-rating, which happened, and now it's got to a point where we think it's fully priced in.
Gotcha. So what could change if the stock does correct downward? Maybe that would be a reason to get in, or if you got a little more clarity on that transition, perhaps.
Absolutely. This is a name that we absolutely want to buy again if valuation becomes sensible.
Gotcha. Do you still hold any of the shares?
Yes, we do.
Okay, you just wouldn't be adding at these
Correct.
levels. Gotcha. Masa, thank you so much for coming in.
Thank you.
Interesting stuff here. Thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.